The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth, and you buy a group of them, you basically don't lose money.
According to reports, Warren Buffett has a net worth of more than $100 billion. From a shy child selling Coca-Cola at local doorsteps to building Berkshire Hathaway into a multi-billion-dollar corporation, the Oracle of Omaha has remained one of the richest people on the planet. He stands apart among the wealthy since he did not inherit his wealth or amass it by technological advancement. Rather, he increased his riches by making steady gains in the stock market. What was his approach then? Where innumerable others have failed, what did he do differently? We will learn how Warren Buffett overcame the stock market and became a self-made investing millionaire in this video. Starting from the very beginning, realizing the importance of money. In August 1930, just 1 year after the catastrophic effects of the Great Depression on the country, Warren Buffett was born in Omaha, Nebraska. He quickly grasped the importance of money as a young boy after witnessing how others battled to make ends meet as a result of the devastating economic crisis. Luckily, his father had a keen sense of business. Despite having recently lost his job at a local bank, he used his meager funds to start his own stock and bond trading business, which allowed him to support his family. Growing up, Warren was a quiet, reticent child who spent the majority of his time alone, often reading books from his father's library. He developed an early interest in investing and the business game as a result of this collection. In an attempt to put his newfound knowledge to use, he went to his grandfather, who ran a local grocery store, and asked if he could provide Warren with drinks to distribute throughout the area. With his grandfather's approval, Warren started his first business at the age of 6, selling Coca-Cola door-to-door for 5 cents per six-pack. By the time he was 11 years old, the child had used all of his funds to buy his first stock. He bought 3 shares of City Service, an oil and gas company, for $38.25 each. But soon after they were acquired, their value dropped to about $27 per share. He held on to his stake and waited until their value increased to $40 before liquidating them in spite of his anxiety. Even though he had made a profit, he noticed that those same shares later increased to more than $200. Although learning about his lost opportunity hurt, he learned an important lesson from it.
75 years have gone by, and I've never known what the market's going to do the next day. That's not my game. My game is to decide whether I'm in the right economy by owning good companies for long periods of time.
Acquiring knowledge and growing businesses. The Buffett family moved from Omaha to Washington, D.C. At the age of 14, Warren Buffett would get his first real job there, distributing newspapers for the Washington Post. He wasn't happy with the money he made, though, so he took a job with the Times-Herald, one of their competitors, and started distributing newspapers at the same time, making $179 a month. Buffett then used his wages and savings to buy a pinball machine with a friend and put it in a barbershop. And at the end of each week, they would split the earnings between themselves and the business owners. In the end, they sold their machines for $1,200, and Warren Buffett used the money to buy his first property, a 40-acre plot of land in Nebraska. The fact that Warren was only 15 when he bought the farm was the most astounding part of it all. This young Omaha boy was clearly growing into something significant even at such a young age. College years. Buffett was eager to start his career as a full-time stockbroker after graduating from high school in 1947. When he applied to Harvard for a master's degree after earning his bachelor's degree in business administration from the University of Nebraska, he was turned down. But this rejection turned out to be a lucky break that led him to enroll at the Columbia Business School, where he met Benjamin Graham, a professor who would change his life. Graham had just released The Intelligent Investor, one of his best-known works, the year they first met. To put it simply, the book offered a thorough manual on how to buy cheap stocks and make steady, profitable investments without taking a chance. Buffett was eager to begin his career after earning his master's degree in economics, the home of the historic New York Stock Exchange, and the headquarters of the biggest financial firms in the country. But there was one major roadblock in his way. Warren Buffett was still an introverted 21-year-old who couldn't portray himself as the charismatic business powerhouse he has become today, despite his vast knowledge of investment and company management. He would sometimes even throw up from sheer fear and was afraid to talk to strangers. Nevertheless, he mustered the bravery to sign up for a public speaking course, which turned out to be one of his best investments to date.
Investing in yourself is the best thing you can do. The more you learn, the more you earn.
Starting your own business. Shortly after, Buffett received a job offer from Benjamin Graham at his New York investment firm, which the young man gladly accepted. There, he honed his security analysis skills and learned how to determine a company's true worth from its financial records. Although Buffett and Graham continued to respect one another, it soon became clear that their ideas were different. Graham differed with Buffett. Their differences wouldn't matter because by 1956, Graham had decided to retire and dissolve the partnership, making Warren Buffett independent. However, the young man had increased his funds from $9,800 to $175,000, and more importantly, he had gained direct experience running an investing firm in New York. He was now ready to start his own partnership, making himself one of the richest people on the planet and turning those who had invested in him into millionaires. Building his empire, the cigar butt method. Buffett returned to Omaha in 1956 at the age of 25 and established Buffett Associates Limited, his own partnership. Warren had more than enough money to rent an office space and hire some staff, but instead he decided to run the company out of one of his bedrooms. He quickly started his partnership after persuading some of his friends and family to contribute a total of $105,000. Influenced by his mentor Graham, Warren Buffett started investing in cheap stocks. However, he took their philosophy a step further by dealing with underperforming companies that were ready to file for bankruptcy, buying them so cheaply that even their liquidation value was worth more. He calls this strategy the cigar butt.
Anyone who picks up discarded cigars on the street can enjoy a few puffs, which would cost him nothing. Cigar butt investing runs along that same line. You find a terribly undervalued stock that sells for so cheap, you know for a fact it is worth more, and after selling it at its appropriate price, the initial bargain purchase makes the puff all free.
Outstanding achievement and increasing concerns. This strategy turned out to be a fantastic decision for Buffett, and during the next 6 years of his business, the total value of his partnership increased from $105,000 to $7.2 million. Warren Buffett was in his late 20s, yet he still looked like a youngster. He ran his business by himself for over 5 years, writing all the checks, doing the taxes, and taking stock deliveries, which led to numerous potential customers asking him questions. However, those who had the guts to invest in him would see their portfolios grow, outperforming the stock market by a factor of 4 between 1956 and 1969, with an average compound annual gain of 29.5%. After just 3 years, Warren Buffett's assets increased to an incredible $104 million. 10 years into his partnership, he was managing over $44 million in assets. Even while the market was doing well and his partners were very happy with the return on their investments, Warren Buffett adheres to a principle that has always worked well for him.
Be fearful when others are greedy, and greedy when others are fearful.
Changes in strategy and establishing an empire. You know, he found it difficult to carry out his cigar butt investments in an overvalued stock market. By the end of 1969, he had made the important choice to dissolve the business completely and dismiss his partners since he felt it was too hazardous to keep investing with other people's money. Nevertheless, by the time he was 39, he had built up his own fortune to $25 million, and he was ready to carry out his next plan, which was to turn Berkshire Hathaway into $1 billion empire. The purchase of Berkshire Hathaway, a faltering textile company, Berkshire Hathaway was doomed to fail. In 1965, its assets were worth at least $11, but its stocks were selling at about $7. Warren, of course, bought a sizable amount of the company's shares at a cigar butt price of $7.50 each. He arranged a deal with the owner 3 years later to sell his shares for $11.50, but when the final proposal came in, the owner tried to trick Warren by buying his shares for $11.375. Buffett was so incensed by this that he fired him and bought the entire company. However, he decided to gradually remove Berkshire Hathaway from the textile industry and use it as a holding company to carry out his investments, but Buffett's recent bad experience buying cheap stocks has made him reevaluate his investing strategy. Luckily, Charlie Munger, one of his close business associates, persuaded him to change his mindset from buying fair firms at superb prices to great corporations at fair prices. And that decision turned out to be yet another crucial turning point in Warren Buffett's career. He started looking for businesses that he thought had an economic moat. In this sense, moat refers to a company's capacity to keep its market share while maintaining a competitive advantage. Coca-Cola is one example of this. It's a brand that has been around for almost a century and has made connections with billions of people worldwide. Using this new style of thinking, Warren Buffett started investing heavily in grade A companies like American Express and the Washington Post through Berkshire Hathaway. Buffett's personal wealth had grown to almost $240 million by that point. His entry into the insurance industry was what actually enabled him to produce his real wealth. Since people pay their insurance premiums on a regular basis, business owners typically have a significant amount of cash on hand. Buffett realized he could use that money to carefully buy and invest in a number of companies. As a result, Warren started buying insurance companies in 1967, starting with National Indemnity and moving on to Central States Indemnity and Geico. He started buying stock in companies he thought had a moat after gaining access to billions of dollars from those insurance companies. His Berkshire holdings increased so dramatically after that its stock was selling at around $7,000 by 1990. Additionally, Warren Buffett himself had a net worth of more than $1 billion by the time he was 60. Over the years, Berkshire Hathaway has continued to acquire and hold shares in numerous grade A companies, and in 2008, Buffett became the world's richest person. But despite all of his wealth and achievements, Buffett is still an incredibly thrifty person. The legacy of patient wealth. Warren Buffett is a calm contradiction in a world that is fixated on rapid wins and sudden success. Proof that slow thinking may create legacies that expand quickly. Proof that people who learn from history are rewarded. Because in the end, markets may change and numbers may fluctuate, but when principles are patiently applied, wealth may be created that lasts for generations. This is where finance and history collide, and this is Warren Buffett's legacy. For more tales where finance and history collide, please subscribe, like, and share this breakdown. I appreciate you watching. I'll see you at the next one.